Erin, you're joining us here from one of your remote locations, like many of us are right now. Let's talk about how exactly investors and people out there trying to put money to work are navigating this kind of a market.
Yeah, so we have seen some of the more defensive plays, like in your consumer staples, in some of your utilities, and they've been holding up a little better than most of the markets. Of course, we do see on these big down days very high correlations. Another couple areas that we've seen performing a little better than some of the others are healthcare and, interesting enough, information technology. So obviously, as we're all reverting to new technologies and buying in-home cameras and so on and so forth, that does seem to be one area that is helping. However, I think before investors really think about jumping into the market and doing very stock-specific picks, I think we really need to look at the broader economy and how long we see this recession going. Because when you do look at Wall Street forecasts, we're looking at a massive contraction, both in the first, second, and third quarters. And if we don't get the containment underway, this could easily spread into fourth and fifth quarters. And as you mentioned, the massive rise in unemployment certainly is going to take multiple months to fully recover. I think most people have let go of the idea of a V-shaped recovery. And that we really need to look at this as a much longer term type of recovery where we may not see more positive news until 2021. I am a little concerned that as we go into Q1 earnings, as they may or may not make the headlines depending on what's happening with the virus and the spread.
Sure.
I think that's going to be another sort of negative where investors also get some somewhat disappointing news and realizing just how bad it may look for these companies over the next several quarters. So we're not talking about just a hit in the first quarter or the second quarter, but very potentially third and fourth quarters as well.
Sure. So you've laid out a fairly conservative, if not maybe dire, base case scenario for earnings and the markets overall. Then how are you positioned, or how are you going to position, given that view, knowing that this may not be in your mind a V-shaped recovery?
Right. So one thing is, so fortunately, at least Wall Street is always forward-looking. So even if we have negative or contracting growth in the third and fourth quarter, if we see potential for positive growth, let's say in the first and second quarter of the next year, the market can rally within the second half of the year. We're always looking 2 quarters ahead. I think it's more just for investors to really fully understand the implications. So for me, I still see another leg down here within the stock market. And when you actually look at the investor behavior with a lot of the major indices, there does tend to be a bottom when it comes to sort of a valuation low where investors stop. And right now for the S&P 500, that's about 14 times earnings. Unfortunately, earnings keep dropping, so that target or the actual number of the index keeps lowering. But for me, I'm looking at sort of a support around 2,200. If that can be held for multiple periods, particularly during earnings season, and if we do see more positive news around vaccines, around testing, for me, that could be a sign that we're seeing some type of bottom. But I don't think we're there yet. I think there could be some other big disappointments as we face earnings season. And until we really see containment and a more positive news around case numbers, I definitely think there's more vulnerability to the downside.